What's up, guys? In today's video, I actually have a full guide on the stock market for beginners for you guys. So the way that this is going to work is I've created a PowerPoint presentation. We're going to go through each one of the slides and kind of give you a brief overview of the stock market if you're a complete beginner. So right now, let's go into the presentation and let's get started. This presentation will also be available online for you guys as a download, and I'll put that in the link in description for you guys below as well. So let's get started quickly here, and let's go first into the first slide, which is why me? Why should you listen to me for your stock market advice? First of all, I graduated with a finance degree in 2009. That seems a long time ago now. I worked in tech for a couple years after that. I did a couple random odd jobs. I did some customer support, some quality assurance, but ultimately I decided, hey, I was kind of into finance. It's something that I'd always wanted to try out. So I became a financial advisor for Merrill Lynch in, I believe, 2012 to 2013, where I got the Series 7 and the Series 66. So those are the two licenses you need to practice financial advisory, which I did receive. After that, I worked at the top grossing iOS and Android games from 2014 to 2016. If you guys do remember the video games called Game of War and also Mobile Strike, I worked at those two companies as a monetization specialist. So my job was to figure out, hey, how can we get players to spend more money? I've also been investing for 10 years now, so I do feel like I have somewhat of a good experience in terms of investing context. And I'm able to explain things in a pretty simple manner, which I do hope you guys enjoy. So with that being said, let's get into the next slide. Before we get started, this entire course or this entire guide today is going to be free. And I always plan on making my content free, but if you would like to support the channel, you can do so by using some of these links in the description below, but I'll also put them in the PowerPoint for you guys. But with Robinhood, you guys can get a free stock valued up to $200 whenever you deposit any amount of money, which is pretty cool. With Webull, you can get 2 free stocks. I think it's actually valued up to $1,850 right now. I said $1,800 in the PowerPoint, but I think it is $1,850, but you actually have to deposit $100 with them. Public, you can get up to $10 of free stocks with your choice. So you can choose between, like, they give you 20 different stocks you can get $10 worth of. And Wealthfront is a robo-advisor, but they're offering you 10K managed for free. This is not sponsored by them in any way, but they are one of my sponsors, so I really do like them. I actually have used them in the past, so shout out to Wealthfront. Free guides. There will be an Investing 101 free guide for you guys, also in the link in description below. So be sure to check that out as well. And I do have a Discord server that's completely free. If you'd like to hop in there and chat with other like-minded individuals when it comes to investing, that is available for you guys. So the free stocks, those are all brokerage accounts, by the way, and we'll get into what a brokerage is in today's video. So I will refresh this at the very end of the video. Don't worry, it'll always be there. So what is investing? Investing is simply just allocating your funds towards a future expectation of return. So you either expect to make a profit or an income. So for example, if you invest $1,000 into your house renovation, you expect that that $1,000 is going to pay you back a return on your investment somewhere down the line. So in my example here, I am investing $10,000 into an S&P 500 index fund. On average, an S&P index fund would probably return about 8% a year. So over 30 years, I would expect to turn my $10,000 into $100,000, right? And that's just based on compound interest alone. So let me show you guys an example here. I actually have the compound interest calculator pulled up. We just took $10,000. We didn't add any money to it, but we just let it grow for 30 years at an 8% interest rate. That future value would be $100,626. So that's kind of what we're looking for when it comes to investing. We want to invest our money and get a return later. Now, the returns clearly depend on the type of asset class. So there are things such as REITs, which we'll get into, ETFs, individual stocks, cryptocurrency, for example. Depending on how much risk you take, the amount of returns that you actually get back from the risk that you take really will vary widely. So we'll talk more about that today too. So why should you invest in the stock market? So inflation is definitely one of the reasons why you should invest in the stock market. Money loses value over time due to inflation. I'm sure you've heard this before, but back in like the 1950s, gas used to maybe cost 25 cents a gallon. These days, it's closer to $3 or $4 a gallon. That's due to inflation. So historically, inflation is targeted around 2% by the Fed. And right now, savings rates at banks are actually less than 2% per year, which means that the average savings rate is less than the inflation rate. So if you're just putting your money in the bank, you're actually losing your money purchasing power. So the purchasing power of your money is going to be lessened over time due to inflation. The other reason why you should invest in the stock market is returns. So investing in the market historically has averaged about 8 to 10% per year, as I mentioned in the previous slide. And it's one of the best ways to leverage your money and to continue to grow your wealth as you make an income. Another reason why you should get into the stock market are fees. So many brokerages and institutions these days are offering $0 free trades, and that used to not be the standard. So the standard of the industry back in the day was $8 trades or $10 trades. It used to cost money to make these trades, but with the advent of a lot of these fintech companies, these days, you can get trades for free, and that's one of the benefits of investing in the stock market today is that it's a lot cheaper than it used to be. Not only that, a lot of expense ratios out there for passively managed funds, which we'll get into what an expense ratio is, but they basically just know this. They basically have really low fees these days. So therefore, the risk to return profile of stocks is something to seek and something to kind of invest your money in. So there are always 3 questions I'd like to ask myself before we get started with investing. Those 3 questions are, what type of investor are you? What's your time horizon? And what's your risk level? So these are really important questions to ask yourself before you get invested, because these questions will sort of guide your decision making on what types of investments you want to get into. So number 1, decide on the type of investor you are. Are you an analytical person? Do you hate math? Do you like to do research on stocks? Do you lean towards being an active investor where you're doing a lot of research and analytics? Or do you want to just be a passive investor and kind of just set it and forget it? So know what type of investor you are. That's going to help a lot. When it comes to your time horizon, how long are you investing for? The longer you're investing for, the more risky that you can actually be, because you have more time to recoup any losses that you might actually incur in the stock market. So sometimes that also has to do with liquidity. So how often or how quickly you need your money is going to come in play here. Lastly, you want to assess your risk level. So how risky are you? Are you okay if your portfolio goes completely down to 0? Because some people are, and some people are really eternally optimistic that even if they do go down to 0, that they can always come back. Some people are way more risk averse. I would tend to say I'm on the more risk averse side. I like to preserve my capital rather than risking it all, but that's just me. So you want to use the above factors to kind of gauge what type of investments that you might want to get into. And we'll talk about the different types of investments today and what risk profiles they actually kind of fit. I even listed here in an example, passive investors may want a passively managed ETF or index fund that they just check once a year, because those are mostly set it and forget it type of investments. So my personal mindset when I'm investing is that I'm more passive, and I believe that by investing in fundamentally sound companies, that their value will be realized over time, and that my portfolio will slowly make gains over time in a risk. I'm kind of just more of a risk-averse type of investor, so I just want a smooth, consistent ride up. Hopefully that makes sense. For my time horizon, I'm generally investing for the long term, minimum 3 to 5 years, and then all the way up to retirement. So I have a lot of ETFs in my Roth IRA, which are mostly for retirement. But I also like to invest in strong conviction stocks that I believe in for the 3 to 5 to 10 year time frame. Your time horizon might also depend on your life events as well. So when you plan to have kids, when you plan to get a house, or maybe when you plan to get married, because those are some life events that are going to cost quite a bit of money that you might want to have money readily available for those life events. As I said before, I'm more risk averse. I like taking concentrated bets when I really believe in something. Otherwise, I'm just looking for diversification and consistent returns over time. So I'm happier with capital preservation, as I said earlier. I don't like losing money. Who does? But that's just me. So how much should you invest? This is a really great question to ask yourself. So first of all, before you start investing, you definitely should have some basics covered. First, I think you should have an emergency fund, which is 3 to 6 months of your living expenses saved up, just in case you lose your job or maybe you get into some sort of accident. Knock on wood, you don't, but you have 3 to 6 months of living expenses that you can kind of live off of in order to prepare your life for the next phase if something ever bad happens. The other thing that I think you should have covered when it comes to investing is that your money for your bills, especially the big bills, are already covered, because you don't want to be investing money that you need. These could include liabilities like tuition, your mortgage, vacation funds, or maybe a home fund, because you want to be able to have those under control before you invest money that you might lose. You also want to know volatility. You want to understand volatility in the stock market. You got to be prepared for it and just understand that when you are investing money, that it might be a bumpy ride. I always like to say that you should not invest more than what you can afford to lose. Now, some people like to get a little bit more aggressive than that, but me personally, I don't invest what I can't afford to lose, and I'd really just like to see that number go up consistently over time. All right, guys, so how to buy stocks. Now we're going to get into some of the more interesting parts of this presentation, so I hope you enjoy. Buckle up. Buying stocks can be done in a brokerage account. And a brokerage account is just simply a type of account that allows you, the investor, to deposit money into from your normal bank to access the market and trade, buy, or sell shares in companies. Common providers that are free include Fidelity, Charles Schwab, E-Trade, Robinhood, Webull, Public, Wealthfront, Betterment, TD Ameritrade. And the answer to this question, which is, can you trust them? They're asking me for my social security number. Yes, it's basically like trusting a bank with your money. They need to verify your identity and also have your social security number on file for tax information as well. So yes, you can trust them, but yes, they will ask you for your social security number. So when you're buying stock in a company, you're actually buying shares of that company. So what are shares? A share is simply a percentage ownership in that company. So when you buy a share, you're buying a part ownership into that company. So for large companies like Apple and Microsoft, one share is just going to be a very small fraction of the company itself. These companies typically have a lot of shares that are out there on the market. So buying one share doesn't mean quite a lot, but yes, it technically means you're a part owner. So in this example, Apple actually has 16.79 billion shares that are out there. So if you own one share of Apple for $127, that basically grants you one out of 16.79 billion worth of ownership. I don't even know what that fraction would come out to, but it's a very, very tiny amount. Companies offer shares for a multitude of reasons, but mostly it's to raise money for different types of initiatives they might have. So they might want more growth to pay off debt. They might want to invest into research and development to make more products, etc. Now, a frequent term you might have heard of is something called market capitalization. And so let's talk about this really quickly. But basically, a market capitalization term just refers to the total value of the company. It's calculated by multiplying the number of shares that are outstanding of that company times the price per share. So in our previous example, we knew that Apple had 16.79 billion shares that were out there. And if they're trading at $130 per share, that means the total value of Apple in market capitalization terms is $2.2 trillion. Now, there are categories of different companies that you can invest in by market capitalization, and this is generally how people like to assess risk when it comes to individual stocks. But there are large cap companies, which are $10 billion worth of market cap and up. And these are less volatile during rough markets. They're usually dividend-paying companies and stable companies. Now, as you get smaller, you can see it gets a little bit riskier. In the mid-cap section, these are companies worth between $2 to $10 billion of market cap. They're not yet the large capitalization market cap companies, but they're slightly more seasoned than the small cap companies that are very risky. So let's talk about the small cap companies, because these are the smaller companies. These are worth between $300 million to $2 billion in market capitalization. They're more volatile, they're riskier, but they have a huge potential for growth because they're so small. If you think about it, Apple's potential for growth is, they still have a potential for growth, but it's more limited in terms of their upside because they're already so big. But a small company that's really nimble, they could potentially just 10x, 20x one day because their market cap is still so small and they're still such a small company. So with that being said, let's talk about the different types of equities that you can invest in on the stock market. This is the brief overview. We're going to talk about individual stocks, index funds, ETFs, which are very similar, mutual funds, which are also very similar, and REITs, which is a real estate type of passively managed fund. So with individual stocks, and each one of these slides, by the way, will come with an Investopedia link if you'd like to just go check out and read more about that certain term. But individual stocks have pros and cons. So individual stocks, the pros include reduced fees. You don't pay any management fees like in an ETF or an index fund. The second thing is that you're in control. If you buy into a mutual fund, which we'll get into pretty soon, oftentimes you can't choose what the fund chooses to buy. But with an individual stock, you can know exactly for sure that you're going to own that in your portfolio and only that. The other pro is that you can control the timing on gains and losses because it's so much more active and you're so much more hands-on. The cons of investing in individual stocks are the following. So if your portfolio just consists of a few individual stocks, it's going to be hard to diversify those stocks individually unless you buy more stocks. So let's say your portfolio just contained 3 stocks. If one of those companies went bankrupt, you only have 2 others to rely on, which is a big problem. The second is that it requires more time. So if you're looking at individual stocks or investing in them, you're going to actively be managing them, and that might take more time than you might want. The last con is emotion. Emotion can come into play when it comes to investing, and with individual stocks, it's really easy to sell them or buy them at any given time. And if you let your emotions get the best of you, you might sell at the wrong time. The next type of investments are index funds. Now, these are really popular these days, but index funds are just baskets of stocks, typically tracking an index. So imagine if you had $100 and instead of investing $100 into 500 individual companies of the S&P 500, by investing $100 into an index fund, you are distributing that $100 among the top 500 companies automatically. The pros include increased diversification. Because you're buying into a fund that's tracking an index, for example, you are getting exposure to a lot of different companies. Number 2, they typically have really low fees. So Vanguard funds are the most popular index funds on the market because the index fund was created by Vanguard, and they have the lowest fees on the market of 0.05%. So that means for every $10,000 that you have invested in index funds per year, you're only going to pay $5 in fees, which is a very reasonable amount. The next pro is that they're passively managed. These are really good investments for someone who just wants to stay hands off. And it's something that I personally love and own. It's also a really good investment strategy for most investors. It has solid returns if it tracks an index, historically 8 to 10%. And really, it's set it and forget it. So the cons are that sometimes it has a minimum investment required. A lot of the Vanguard funds, especially the index funds, have a $3,000 minimum, which might be harder for new investors to reach. They're also boring because you don't really have to do anything. There's no active management. They're not sexy in any way. You are just putting your money into a fund and forgetting about it. The last is that the returns are not astronomical. You're not going to get a 10x or 20x index fund in a single year, but you could do that with individual growth stocks. So that is the last con of index funds, I would say. Now let's talk about ETFs. So ETFs are also baskets of stocks, but they're often focused in just one sector of the market. The pros are you get diversification across that one sector. ETFs are usually passively managed. They usually also have low expense ratios and fees. Obviously, there are some exceptions to this. There are actively managed ETFs, but I'm not going to get into those. But those usually have a higher expense ratio or a higher fee because they have to pay an active manager. But ETFs are usually passively managed, and they can actually be more tax efficient than index funds because they do not take what's called, or they do not report what's called a capital gain. When it comes to index funds, sometimes they have to change their holdings and they have to actually take on a capital gain versus in ETFs, that doesn't really happen too often. When it comes to cons of ETFs, they're usually too focused on one sector. Obviously, you can buy a ETF that tracks the S&P index. That wouldn't be too focused on one sector, but most ETFs out there, they're typically designed to track a sector. So that could be one of the cons, is that maybe you get only exposure into, let's say, the electrical vehicle market, but not enough exposure into other types of sectors that you might care about, like consumer discretionary or finance. The other con is that there is a cost to owning ETFs. That's pretty standard. ETFs are passively managed, but they also have an expense ratio, so you are going to be paying fees and expected to pay fees. All right, so now let's talk about mutual funds because they are actually the most popular type of investment out there. Mutual funds pool money from investors to actually buy assets, stocks, and equities. So when you're investing in a mutual fund, a professional fund manager is actually buying those securities for you, and a professional fund manager is actually making those decisions as to what goes in that mutual fund. It's one of the most popular types of investment in the United States. That's probably due to the financial industry because they charge higher fees. A lot of the industry is kind of pushed to push mutual funds onto you. So if you ever do go to a financial advisor and you sign up for a financial advisor, they might actually suggest mutual funds, but I actually don't love mutual funds. That's just my personal opinion. Now, here's some of the pros though. You do get active portfolio management. You get some diversity, which is diversification. And they're also pretty liquid because you can sell them anytime you want. However, the cons are is that they usually have higher fees. You're usually relying on that fund manager to perform well, and a lot of them actually don't outperform the S&P 500. So capital gains tax is also sometimes incurred, as I mentioned earlier, with index funds because you're making changes in the overall mutual fund portfolio. That fund manager actually might incur some capital gains when it comes to selling some of those holdings for different holdings. All right, the next type of asset that you can buy are called REITs. So REITs actually stand for Real Estate Investment Trust, and they basically own and operate income-producing real estate, usually in the form of commercial real estate. Essentially what they do is they pool together funds and they invest in different types of real estate. They collect that rental income from that real estate and then pass it back to you as an investor. So the pros are, 90% of their income is legally required to be paid as you as a dividend. Number two, they're pretty liquid. They just trade on the stock market. You can buy and sell REITs pretty quickly. Number three, you get diversity across many different real estate properties, and you also get exposure to the real estate market without ever having to have, let's say, $500,000 to go put down on a house. The cons are that they're usually low in growth. They have higher management fees, and they're really subject to how the market is doing. So if you remember back during the pandemic, a lot of these retail businesses got hit hard. And as a result, a lot of the REITs that own those retail properties got hit really, really hard as well. Okay, so what is a bull versus a bear market? I'm sure you guys have heard these terms before. So a bull market is when a market experiences price increases over a period of time. A bull market exists when the market has risen 20% or more above its near-term lows, and overall there's an optimistic sentiment. You usually hear a bull market when people are in a good mood and they want to buy more and more. They think everything is going to go up. That's a bull market. A bear market occurs when a market experiences price declines or you see a pullback and there's usually some threats of a recession or a threats of a global financial crisis, something like that. When securities fall 20% or more from their recent highs, that's technically a bear market. And there's overall some negative or pessimistic sentiment in the news and the media. For example, people think that everything is selling off and everything is going down the drain. So those are the differences. So when someone says they're bullish on something, that means they're optimistic for the future. When they're bearish on something, that means they think that investment is going to go down in price. All right, now we're getting to the next part of this presentation, which is how to research stocks. And there are 4 things that we're going to talk about today. Number 1, financial statements. Number 2, financial metrics to compare stocks against. Number 3, qualitative measures. And then lastly, I'll give you some links to different websites and resources where you can research some stocks. So when it comes to financial statements, there are popular financial statements out there that you can look at for any public company that's trading on the stock market. You can download what's called the Form 10-K, which is an annual report of the company's financials. There is usually in the Form 10-K a balance sheet, an income statement, and a cash flow statement. The Form 10-Q is the same thing as the Form 10-K. It's just the quarterly version, and it gives you more recent findings on their operations and financials. So you can actually use sec.gov to look up financial statements. So let's actually do that right now on the screen and go right here to sec.gov. If you just click in the top right here called Company Filings, you can just type in a name, ticker symbol, or CIK. I actually don't know what CIK stands for, so my bad. But let's just say we want to look up Apple. You can do that here, and then as you can see, they have latest filings on the left. You can look at their 10Q, which is right here, but I like to look at the 10K, so we're gonna go over here to selected filings and go down to September 26, 2020, the 10K annual report for the year ending September 26, 2020. When you open this guy up, this thing is really, really long, guys, and I have definitely read a couple of these, but not many in my lifetime. I usually just go down to the table of contents right here, and you'll be able to see that they have item 8, financial statements and supplementary data, or item 6, selected financial data. So let's actually click on item 8 and see what we get. And if we scroll a little bit down, we see their consolidated statement of operations, and these numbers are in millions, which are pretty crazy. So every number that you see over here, for example, their net sales, the products section is 220,747, but that's actually in millions. So that's actually $220 billion in product sales that they had in the year ending at September 26, 2020. I really like the consolidated statement of operations that Apple offers here because you can kind of get a good trend of how Apple is doing. You can see back in 2018, they did about $225 billion in sales. And then in 2019, they did $213 billion worth of product sales. And in 2020, they did 220 billion. So you can kind of see that they're kind of flat in terms of products. That means they're selling the same amount of products every single year. But if you notice their services revenue, it's actually pretty good here. You see that in 2018, services made up about 39 billion of their revenue, but now it's kind of going up and up and up. And so services is becoming more of a play for Apple. And if you watch some of my Apple videos, you would know that, but it kind of shows you how their business is changing from a financial statement model. So that's the consolidated statement of operations. And if you scroll down, you can see their consolidated statements of comprehensive income. And, then you can see their balance sheet here and so on and so forth. They have almost everything that you can ever think of. They have their cash flow statement. And so you can really dive into some of these financial statements as a way to research stocks. So next, we're going to talk about some of the financial metrics that you can look at when you're comparing stocks against each other or companies against each other. Number one, revenue, which is the amount of money that they brought in during that period, aka their total sales. You can also look at net income. Now, net income is pretty important because this actually shows the amount that the company is taking home after all costs. So this is also known as earnings, and earnings is a term that we're going to get really familiar with because of these next metrics here. The next metric is earnings per share. This just shows the company's profitability on a per share basis, and it's something good to pay attention to. The return on equity metric is basically a measurement to show how much profit a company makes with each dollar that the shareholders have invested. So let's say Apple made $50 billion, but the shareholders had invested $100 billion, then Apple would have made 50 divided by 100 or 50% return on equity. The next ratio is pretty important. It's the PE ratio, which is the current stock price divided by earnings per share. That seems a little bit confusing, I know, but it's basically just a metric that shows you how much investors are willing to pay to receive $1 of the company's current earnings. And we'll go a little bit deeper on this in the next slide. The last financial metric that I think is important to pay attention to is the PEG ratio. It's basically an enhanced version of the PE ratio that actually just factors in the growth rate. So there is more info linked here which will be in the presentation if you download that on your own time. All right, guys, now we're getting into a deeper dive on the price to earnings ratio to actually compare companies. So price to earnings, as I mentioned in the previous slide, is how much you're willing to pay for $1 of that company's earnings. So typically a lower price to earnings ratio is better for a value investor because that means you're getting a good deal on every dollar of earnings. In general, a high price to earnings ratio suggests that investors are expecting higher earnings growth in the future, so they're willing to pay more per dollar of earnings that company has. With price to earnings ratio, it's best to compare companies in the same sector. So you don't really want to compare Tesla to Coca-Cola, for example, because the price to earnings ratio, while it does make for a good apples to apples comparison, it doesn't really make a good comparison when it comes to different types of sectors because Tesla might be in a completely different sector than Coca-Cola, which they are, and they're going to have way different metrics to value Tesla versus Coca-Cola. Historically, the S&P 500 price to earnings ratio has ranged from 13 to 15. So that means for every dollar of earnings that the weighted S&P 500 actually has, people are willing to pay $13 to $15 for it. So let's actually go through an Apple versus Microsoft example to show you the differences in PE ratio. So we're going to go over here to FinViz. If we actually just type in Apple, we can scroll down here and we can see all their financial metrics. There's an ad here. We can see all their financial metrics right here, and you can see that the price to earnings is 28.02. That means investors are willing to pay $28 for every single dollar that Apple earns in earnings. Now let's look at Microsoft. Microsoft has the price to earnings ratio, it's higher, of 33.08. That means investors are willing to pay $33 for every single dollar of earnings that Microsoft has. So this actually might suggest that Microsoft is expecting more growth in the future, and that's completely up to you whether you think that is going to be true or not. But investors are clearly saying, and the market is clearly saying that, well, Microsoft is worth a little bit more per dollar of earnings to us than Apple is. So maybe they don't expect Apple to grow as much as Microsoft in the future. All right, let's get into some qualitative measures. For example, number one, what does the company do and how does it make money? You want to understand the business because understanding the business is pretty important when it comes to investing. You don't want to invest in something that you don't completely understand. You want to try to start off investing in businesses that you do understand because this is going to give you the best chance at success. Number two, look at how good the team is. Do you trust the CEO? Have you done research about him or her? Are the leaders competent? Have they had experience in similar fields? Because if they do have experience in other fields, that could be a pretty good sign. Lastly, check out the board of directors. You can always look up the website of the company, for example, Coca-Cola, and look up their board of directors. What's the breadth of their experience? Do they have experience managing other type of companies in the similar space? The third thing you can look at are moats. And so moats are basically competitive advantages. So what kind of competitive advantage does this company have over another? Are they difficult to replicate? Lastly, you want to look at the different types of risks that the company might face in the long run. So for example, you try to identify potential red flags such as, oh my God, this company has a really great idea, but their patent is expiring this year and that's going to bring on more competition. That would be a bad thing. You can also look at different types of market shifts. So Blockbuster was an example of, sadly, a company that didn't pivot fast enough in the digital world of streaming. And all of a sudden, that was a risk that they didn't foresee happening to them, but it did happen to them. And as a result, because they didn't adapt quick enough, they went out of business. So market shifts like that could also be a risk factor, and that might be harder to predict. However, if you are keeping your eye on what's going on in the world, that might be something that you could predict a little bit better than other people. So what should you look for in a value stock? Because that's the type of investor I am, so that's why I'm including this. But a value stock by definition is a stock that is trading lower relative to its fundamentals. So by investing in the company, you're strategically just betting that the market will realize the company's value over time and reflect that in the share price. In terms of profitability and revenue, we want to see growing net income year over year. So you want to look at the Form 10Q and 10K, and you want to make sure that the growth of the revenue is trending. Sorry, not the revenue. The growth of the net income is trending for the past 3 years up and up and up. You also want to see growing revenues year over year. So maybe I was right about that. The next thing you want to look at is the price to earnings ratio. It's typically lower than 20 to 25. It definitely depends on the industry, but you want companies that are a good deal to buy and may seem a little bit undervalued. The other thing you can look at is a good executive team. What kind of management does the company have? And does that management have a good track record? Especially at a value type of company or a value stock, you want to make sure that the leadership is good and guiding that company in the right direction. Lastly, do you believe in the vision and their future that they pitch? And you can definitely just listen in on a conference call on any type of quarterly earnings report, and you can learn a lot about what the company is looking to do in the next quarter or the next year or the next 3 to 5 years. A value stock typically has a smaller upside, but is more stable and grows consistently over time, and that is why I like looking for value stocks. Here's some links to research some stocks that I will leave for you guys in this PowerPoint. You can check out Investopedia. It's an overall great resource for concepts. Seeking Alpha, you can read analysts' take on other different types of stocks. Finviz.com, which we checked out a little bit earlier, but Yahoo Finance is very similar. The next thing you can do is just Google investor relations of any type of company. So if you typed in Google, for example, Apple investor relations, you can go to that website, and they typically have conference calls on these pages where you can get a link to the conference call whenever they're doing a quarterly earnings report, and you can learn a lot that way. Lastly, as I mentioned earlier, you can look at the 10K and 10Q on sec.gov. So before we get into the live demonstration of actually buying a stock on camera, let's actually talk about taxes on stocks really quickly, because it's an important topic that people need to consider. When it comes to taxes on stocks, there are what's called realized versus unrealized gains. To realize a gain, that means that you actually liquidate or sell your position for a profit or a loss. So it's been actually executed, and realized gains can actually be taxed at capital gains tax rates. Now, unrealized gains are not taxable. That means if you just bought and held a stock and never did anything with it, for example, you didn't sell it, you didn't try to trade it, then that is actually categorized as unrealized, and those gains are not taxable until you actually realize an event such as selling the stock. If you own the stock for less than a year, that would be a short-term capital gain, and that would be taxed at your ordinary income tax bracket. If you owned it for longer than a year, you actually qualify for a lower rate, and I actually messed up the PowerPoint here, but it's actually taxed at a capital gains rate, which is between 0 and 20%. You can also have a capital loss. So when you lose money on a stock, you can actually offset any capital gains that you have by up to $3,000 per year with capital losses, which is a pretty nice perk when you lose money. So let me give you guys a really quick example. Let's say you buy $1,000 worth of Apple, the shares go up 50%. You now have $1,500 worth of Apple. let's say you sell all of your shares for a profit, so you realize that gain, you would owe taxes on the $500 of gains that you actually incurred. So when it comes to order types of buying stocks on the stock market, there are some things called market buys and sells versus limit buys and sells. So let's go into the difference between those two. A market buy just means I want it now, so it buys the share at the current price with some fluctuations, of course. Now, it can be placed whenever, but it will only execute during market hours, which is between the hours of 9:30 a.m. Eastern to 4 p.m. Eastern, Monday through Friday. A limit order, on the other hand, means that you can set the price. So if you wanted to buy a stock at a certain price, the order only will go through if that price can be met. And this can be placed as a day order, which means it's good for the day or the entire trading day, or it can be good till canceled, which is a period of 90 days. Other order types could include something called stop losses, stop limits, trailing stops, and those are not going to be included in today's presentation. If you are interested in those, just make sure you YouTube it or Google it, and you will get a really good description on those. So let's go into a live demonstration now of buying a stock on Robinhood, and I will show you guys exactly what the difference between a market order is versus a limit order. So now I'm in my Robinhood account, and as you can see, I'm on the Activision Blizzard stock page, and right now it's trading for $93.87, and you can tell that this price is fluctuating because of how it's being traded on right now. But let's say I wanted to buy one share of this. I would just simply go over here. It says buy ATVI. You can choose one share, and that would be an estimated cost of 93.84 because that's what it's trading for right now. And I can tell that this is a market order because if I just click this arrow down here, it says market order. And if I click review order, it says you are placing a good for day market order to buy one share of ATVI, which I am. So I'm going to press buy. And boom, I am now an owner of Activision Blizzard. I have one share purchased at 93.87. So that is a market order. It's pretty simple and straightforward. It executes as quickly as possible. Now let's talk about a limit order. So let's do the same thing with Activision Blizzard here. Or actually, let's buy some other type of stock. So now let's say I wanted to buy one share of Ford, but I want to use a limit order. So let's go into fordmotor.com. I think that'd be a pretty interesting stock. And it says right now it's trading for $12.07, but let's say I was only willing to pay $12 for this share. I could come down here and click limit order, and I'm only willing to pay $12 for it. I'm willing to buy one share. And you know what? I want this order to be good for 90 days because I don't care when it executes. I'm just willing to buy one share of Ford for $12. So I'm going to click good till canceled. Now, I can also choose to allow this order to execute during extended hours. So the market closes at 4 p.m. Eastern, but if we want it to go actually execute after hours, we can do that too with this button. And so I'll review this order really quickly. It says you're placing a good till canceled limit order to buy one share of Ford. Now, your pending order, if executed, will execute at $12 per share or better. Okay. So now that F order is placed, which is the Ford order is placed. And that actually means that nothing happens yet. Like I haven't actually bought the stock, but if this price of Ford actually dips down to $12, then the order will automatically execute, which I think is pretty cool because that means you could be sleeping, you could be away from your computer or away from your trading app, and that order would go through at the price that you want it to go through at. So I always thought that's pretty cool. That is what a limit order is. And the same thing happens with limit sells. So if we actually go back to Activision here, I still own that one share that I own, but let's say I wanted to do a limit sell. Right now it's trading for $93.89, and let's say if it ever hits 94, I want to sell it. Same kind of options here. I want it to be good till canceled. And yep, there we go. So that now that sell order is placed. I actually haven't sold the stock yet, but if it ever goes up to $94, I will sell that share for Activision Blizzard for $94, which means I would have profited a whopping 13 cents. All right, guys, so that was the entire stock market for beginners presentation. I really do hope that you enjoyed. If you would like to check out some of these free resources for you guys, you get free stocks, and that actually helps directly support the channel. So I do appreciate if you do use any one of these links. This presentation will be available for download in the description below, as well as you should definitely check out my Patreon. That's where I have buy and sell alerts, and you can get access to my investing portfolio. That's going to be below as well. Lastly, if you are interested in seeing more videos from me, make sure to like this video and also subscribe to my channel. If you tick the notification bell too, you get notified whenever I drop a new video. All right, guys, I hope that you enjoyed. I will see you guys in the next one. Peace.